Episode 130, Life Insurance Options. I'm your host, Dr. Justin Trosclair, and today we're Trevor Jackson's perspective. Join 2017 and 2018 Podcast Awards nominated hosts as we get a behind-the-curtain look at all types of doctors and guest specialties. Let's hear a doctor's perspective. How's everybody doing? Recharged? Ready for the rest of the summer? Remember, sometimes summer can be slow, but you don't have to be that way. If you planned ahead, you could have had events scheduled for the summer, maybe on the weekends, health fairs, all these events to where you actually are staying busy, keeping on top of that new patient marketing plan. And if you say, man, it's already too late for me, okay, cool. Move on over to, say, October or December and start planning now for what can you do then. Start checking websites, and you'll be able to find community calendars, Christmas events, Halloween, could be a promotion. So just look ahead a few months and try to plan something. That way you can stay on top of the new patient cycles. Want to throw out there, haven't mentioned this in a while, Today's Choice is Tomorrow's Health book. We're talking lessons from China, blueprints for cardio and weightlifting, because I used to not enjoy those things and now I do. Basics about actually finances and things. We're already talking about that. Sticking to a budget, making a budget. Intermittent fasting. Definitely some strength exercises and stretches that you should be doing or could be doing to keep yourself strong. I had a lot of fun writing this book, so check it out. adoctorsperspective.net/TCTH, or you can get it on Amazon at /mybook. Okay. One thing fun about living in China is I can actually source products easier. Pretty much anything you can imagine that you would find in one of those magazines for promotional items. I can find that here. I work out. I like to wear those dry fit, fast, moisture wicking type of material. And I've even found some that are polo style that actually look good, feel good, and work. And so I was like, man, they probably have those things. Like, when I have a clinic, I could probably get might have to order 300 of them. But really inexpensive. They'll do the printing for you as well, ship it over, and you can get a shirt for like $6 versus the way it usually costs, which is more. And not just some old dumb beefy tee that's like uncomfortable, but actually like a quality polyester or a blend or whatever. Like if you want, nice tri-blend, they have those. If you want like a workout shirt, they have those. So like this week I got a couple of samples in, and tell you what, if you're into the clothing manufacturing companies, the front's one kind, and then in the back of the shirt there's bigger holes. Well, what would that look like throughout the whole shirt? What does it cost to have the front and then the back different? All kinds of different variables. Way more than I expected to have to deal with. I was just like, hey, do you have these shirts with this material already done? All we do is do some silk screen and mail them. And it's turning out to be more work than that. So I can imagine if somebody wanted to produce an entire clothing line, the amount of details. It's pretty wild. That's neither here nor there. Just if you're interested in that kind of stuff, some of the mini-sode episodes talk about like Amazon and marketing ideas and the shock and awe box that some people talk about. Real quick, shock and awe box would be new patient comes in, maybe they come in, they spend a certain amount of money, or they are there like a couple times, and then you mail them a box. It might have a shirt, it might have a mug, a water bottle, all branded, quality stuff where they'd actually want to use them, stuff like that. Maybe if you had a book, you can put your book in there. And books are real inexpensive to print if they're black and white. It's like a big business card and hopefully has what you believe and think about. And they're not always up to date. Like you might have changed your position on certain things, but to get them reprinted would be tough. So you can just make a note of that to somebody if you really cared. Put a little letter on top, put that in the mail. My goodness. Can you imagine getting a box in the mail randomly from your chiropractor or dentist? Just saying, hey, thanks. Welcome to the clinic family. All right, that's enough. Trevor Jackson today. We're talking about life insurance. We covered it a little bit on the last episode, but we're going to go deeper because there's these things called be your own banker, infinite banking, tax-free retirement. Generically, the idea is that you buy like a whole life or universal index, and you can use it for a retirement plan. Like you put more money than you have to in it each month, and then later on you can like buy a car and just pay yourself back, so you're acting like the bank at an interest rate. But then the money that's in there that's growing each year, because it's tied to some kind of market, it keeps growing, even though you borrow some from it. And you just got to pay it back. And it's a little more complicated than that. Obviously, that's why this whole show is based on this. But we'll discuss all the stuff that you would want to know, how to use it as a retirement supplement, but also just sort of like as part of your retirement plan, like diversifying your tax buckets. We'll go through what $1 million baby plan is. It's kind of a cool idea. Break down what family banking is, super funding, living benefits. That's a really cool thing. If you had a stroke, you can start tapping into your life insurance before you actually die. So real cool stuff. We got the national vice president of this one company on, Trevor. So All the show notes can be found at doctorperspective.net/130. Let's go. Hashtag behind the curtain. Live from China in the Denver metro, Colorado area. Today on the show, we're going to continue the financial series. We're going to talk about something that it's hard to get your head around sometimes, or at least for me. And his backstory real quick, he was in health insurance. He was really knocking it out of the park. And I think eventually you get to the point where you need a new adventure. And so he started in 2011 with this place called Five Rings Financial. And since then, he is now the national vice president, travels all over the country speaking about the basics of money, investments, and all those things that we probably should learn in school, but we didn't. So please welcome to the show, Trevor Jackson.
Hey, thanks for having me, man.
So good to see you again. It'll come out at some point. We knew each other way back in Colorado, and it's just been fun, 10 years later or whatever, you start to see someone else's, somebody has a kid, they become the national vice president, and you're like, man, I knew this guy when he was nothing. This is crazy.
Right. Just peddling health insurance.
Yeah. It's funny. I don't know if it was a money thing, but people who sell health insurance seem to always get out of it after a while because I guess that's what I've noticed, that the commissions aren't quite there for the amount of work that it takes.
Yeah.
I don't know if that's was your case or not.
Absolutely. When I got into health insurance, I was straight out of college. Back then, the commission rates on selling health insurance were pretty dang high. And so you could actually make a living selling health insurance. And so that's why I was in it. And then I think when you and I, met, I was kind of on my way out. They'd cut commissions 2 or 3 different times. And I was looking for a new industry to kind of get into. I'd looked at, real estate, a bunch of different other industries, and just kind of decided on the financial industry. I've always been pretty interested in money, like most people are, but found our company and been with them ever since. So,
of all the companies, is there like an angle that they have that's kind of unique before we jump into the meat of this interview?
Sure. Yeah. They are pretty unique in the fact that they're sincere about educating people about money. I feel like it's the cliche thing nowadays for financial companies to say, oh, we're all about educating our clients, but then they don't really follow through on it too well. So our company, we do these educational workshops where, we invite people in for a free dinner, just like a lot of other financial companies do. But with ours, we don't sell any product. It's purely educational, so nobody feels pressured to buy anything. We make it fun and entertaining so people have a great time. And we teach things at a 3rd grade level so people understand instead of trying to speak over everybody's head. And so I really like that about them.
Yeah, that's cool because, there's some professions like chiropractic, for instance, we'll do lunch and learns as well, but there's definitely a sales pitch at the end because why would you be having dinner with a chiropractor? I mean, everybody knows why you're there, but at least you don't have to feel so pressured like, all right, so I'm going to come to your house tomorrow, right, at 5 o'clock. We're going to continue this steak dinner.
Yeah, exactly.
Okay.
Yeah. Well, and that's the big thing. I feel like the financial industry kind of has that negative stereotype that, hey, I'm going to talk over your head so that you don't understand. I look smart and just give me your money and I'll figure it out, right? Yeah. And so people just don't like that. Just by us not trying to sell them anything, they actually do want to offer their business to us, and we don't have to pressure them for it. So. And
like last week's episode, if you listen to that long, it was like an hour and a half. It was so long. But,
wow.
Yeah, we covered like so many different things. So if you don't know any of the terms that we end up talking about today, you can check it out. He can explain it. But there's just so much that you can just confuse people with and I think bamboozle them. And then you don't know what you're buying at the end of the day.
Yeah.
Which is, we probably could have spent a lot more time last week on life insurance, but I knew you were coming up. And the program that we're talking about, there's different names for it. I had read a book called Be Your Own Banker. I think that was maybe the original idea of this. Then there was Infinite Banking, which same thing, different spin. And then now yours is a little bit different completely because yours is kind of called tax-free retirement. Mm-hmm. And from what I had heard, it was always these very specific universal life policies, and that's what you would use. You'd overfund those. You'd borrow money from it. But because you bought so much, the value was always there. And it was tied to the stock market and all this. And I'm doing a pretty bad job here of explaining it. People getting confused. So if you know what I'm talking about, let's just jump in. What am I talking about? And your view on it, and maybe why you chose to do not the life insurance policy part, and explain what we're talking about. Because this is the audience is doctors maybe discretionary income, maybe have enough money to where this program can work. Because I always felt you need to have a certain level of income to make this thing really work. Like you couldn't do it on like 40 grand. I could be wrong, but.
Well, yeah, and that's a kind of a common misconception is we really do work with everybody. But yeah, another reason why I like the company I work with is just because we specifically work with middle Americans. Now we work with everybody, but that's who we really try to target because, all the wealthy have 100 financial advisors knocking down their door every single day, but nobody's going to average Joe's door and trying to get their business. So that's why I try and work with them a little bit more. But as far as the life insurance stuff goes, yeah, there's a bunch of different names that it goes by. So like you said, be your own banker, infinite banking, tax-free retirement. Now, the be your own, I really think that the only difference between all of them is just what the goal of the money is. So be your own banker and infinite banking, that came around basically to start a permanent life insurance policy. And they traditionally used whole life and to grow a significant amount of cash value in it so that you could potentially be your own banker, right? So that if you needed to purchase, let's say, a car 5 or 10 years down the road, instead of borrowing money from a bank, you could borrow it from your own life insurance policy, pay for that car, and then you just pay yourself back instead of having to pay a bank. And then hopefully you're paying a lower interest rate on it, which is then, making you more money on that investment. Now, tax-free retirement, we focus on a little bit different piece, which is the goal of the tax-free retirement is not necessarily to purchase things. Now, you still have that ability, but it's more to set up this as a retirement supplement. So a lot of people don't know, like, why would you want to build a cash reserve inside of a life insurance policy? Well, it grows a lot like a Roth IRA. So you're putting tax dollars into it. It grows tax deferred. And then when you start to take it out in retirement, it's all going to come out tax free. And so every financial advisor, I don't care what show you listen to on the radio, on TV, they always say, hey, fully fund your Roth.
Right.
Right. And the reason is because tax rates are so low right now. If you're thinking long term and you have to pay taxes at some point, you'd rather pay them when tax rates are low than probably in the future, 20 or 30 years down the road when tax rates might go up 10, 20, 30%.
Especially the way, not to go political, but the way 2020 election series is starting to pan out, it seems like there's not a sustainable way to keep our taxes the same level that we're at right now.
Well, and just think of, and you're right, not to get political, but think of, everything everyone wants the government to pay for nowadays. And then also with the national debt that we have, there's only one way that we're going to pay that back, and that's through either actually having a budget, which probably won't happen. It seems like nobody wants to do that, which leaves us with increasing taxes. So I would put my money on tax rates going up in the future for sure.
And it's been 20 years already since we've been out of high school and all this kind of stuff. And we've already seen some things change that we probably never expected to see happen. Our parents, you can't use this water faucet. Like, they would have blown their mind. They're like, oh, in 50 years, you really think it's going to be like that? You're like, yeah, it's going to be completely different. So to think when we're that age, what in the world could be, what would America be is just unheard of. Like, we don't even know.
Yeah.
But, so anyway, that's why I like the idea. I love Roth IRAs. I'm kind of in that camp where it's like, look, I use them. I max them out as much as I can. And then, because later on, it's just tax-free.
Tax-free. Absolutely. Yeah. Nobody likes taxes.
Yeah. So what's the next piece?
So I think the other question that you had asked is, what kind of vehicle do you use? Do you use whole life insurance, or you had talked about just a second ago, universal life? So whole life insurance, I feel like, is just kind of, why do people use whole life? I think it's the old way of doing it. Whole life insurance has been around forever. And if you know anything about the life insurance industry, it is a pretty slowly evolving industry. I mean, they don't change a whole heck of a lot. And so I feel like most life insurance companies, they just use whole life because it's been around forever. So that's what they know, and that's kind of what they stick with. The other types of universal life, and a lot of people don't know that, there's the traditional fixed, which is going to give you a guaranteed rate of return. There's variable, which is tied to the stock market. So it's going to go up and down. You could lose money in it, gain money in it. And then there's also indexed. And that's the one I like the best, just because what it does is it tracks an index like the S&P 500, for example. but it has a floor and a ceiling to it. So let's say over a given year, the market goes down. Well, the floor is at 0%. So worst case scenario, you can't lose any money, but you also don't gain any. But then when the market goes up, you get to participate in all of that upside up to whatever the ceiling is. The company that's probably most popular that we use right now, that ceiling's at about 10.5%. So, I mean, if the market does, yeah, exactly. So you can do up to 10.5% every single year. And then kind of preparing to come on your show here, I was looking up the numbers. So since 2011, the indexed universal life policies have averaged 9.173% a year since 2011, and that's pretty much exactly what the market did. But the difference there is there's no fees to get that 9.173 other than the insurance piece.
And you had mentioned there was another one, the universal. They give you a rate, a guaranteed rate. Is that only like 4% or something? So you don't capture the full.
Yeah, it's about between 4 or 5. Kind of just depends on the company. And that's another reason why I'm not a fan of using whole life for tax-free retirement or something like that. It's just not very effective to build a lot of cash. Number one, the cost of the insurance is much more expensive than universal life insurance policies. And then it builds cash value based on dividends. And the dividends usually only pay, 2, 3, 4%. Again, just depends on the company.
Okay. I like the idea. 0% or up to 10.5%. That's pretty cool. But at the same time, the market can drop. It could drop for several years. So is there a benefit to having one that says, hey, it is only 5%, but it's always 5% no matter what? So even on a slow year, it's 5%. I mean, you have to really compare those. Is there like any historical data, like which one actually wins over a 30-year period?
Yeah, well, I mean, and that's every financial person will tell you, oh, hey, get in the market, right? Because if you look at the historical average of the market, it's going to average about 8%.
Right.
So you got to figure 8% is going to do better than 5, the guaranteed 5. You're right. But the guaranteed 5 is going to outperform it probably in the short run if you have a couple years where the market goes down. But in the long run, you're going to do better with an index, more than likely, if the market performs the way it has in the past.
Disclaimer, past performance does not make future performance possible.
That's exactly right.
We're not your planner.
We'll put an asterisk by the end of the side of this.
The other guy, he's like, you're going to have to read this paragraph for me. I was like, all right, just supply the paragraph. I was like, Luke, you got to cover it. Y'all guys are so regulated.
Oh, yeah. Well, and see, I'm not as regulated. So what we do is, again, the niche of our company is we only work with these indexed or fixed accounts. So we try to be the safe money people just because, there's 100 financial advisors out there who will put your money in the market. And that's just kind of what makes us different is we won't do that. And we can guarantee you won't lose any money because of market performance. So,
and now when you're talking about indexes, like my mind goes to Vanguard, iShares, those types of companies. So we're not talking that type of index. We just mean like S&P 500 or there's a lot of actually indexes out there.
Right. Yeah. S&P, Dow, NASDAQ, Russell, you name it. So the difference is, and a lot of people do get confused on that piece, is they confuse indexed fund with an indexed account. So an indexed fund is nothing more than a mutual fund that directly mimics the performance of an index. So, you can buy an S&P 500 indexed fund. And so if the market goes up, you make money. If the market goes down, you lose money, right? And the fees on it are super low. And so those are usually a great option for people in the market. But then these indexed accounts, like I said, they've got that floor and that ceiling, but your money's not actually invested into the market. They just use the performance as an index to credit you interest.
So the insurance company you bought it from, there as a company is making money off of your money by investing in different things. It's just that they might be making 25% in some amazing deal they have that we'll never be privy to. And they're like, we'll give you that S&P 500 9% this year, but we actually made an extra 10%, so we're still winning. So in case all these people die, we have the money to pay you guys.
Hey, if they want to get risky with that money, they can. Another reason I like the indexed accounts is it's super easy to figure out what you're going to get as an individual. Like I said, somebody who's not in the industry, sometimes it's hard to know, what the market's doing and how your particular portfolio is going to perform. But with these indexed accounts, you can say, hey, on January 1st, the S&P was at X. 1 year later, it's at Y. So that's a 10% growth. I get 10%.
So again, what's the point then? Because we technically are we're buying a policy, maybe $500,000, maybe $1 million. And so anytime we die between now and forever, we know our family members will get $1 million. So why are we wanting to build this cash value underneath it? What's the point?
Sure. Well, just a fund retirement. A lot of people have life insurance, and over the last 20 years, the thought has kind of been, hey, buy term, invest the rest. I'm sure you've heard that.
Yeah, that's what I've heard a lot.
Yeah, exactly. Well, that started 20 or 30 years ago, and it's kind of proven out to not work because what happened was people would buy term and they wouldn't invest anything.
Oh.
So now they're 20 or 30 years down the road, their term life insurance expires, right? They're either, number one, if they want to get more insurance, it's going to be just outrageously expensive, or they're too sick to even get it. And then they have no savings either. So with a permanent life insurance policy, number one, if you pass away too soon, great. You have the life insurance piece. And if you live too long, is what we joke about it, right? If you live too long and you get to retirement, well, great. You have a big pile of money there as well that you can supplement your retirement.
So the idea is I've got my Roth IRAs, I got my 401k, and 63, I'm retired, man. I'm collecting. I got Medicare going on, and I'm living the dream. Then all of a sudden you're like, oh, wait, I have this life insurance policy. I've got another $1 million in there, and actually you just draw that down over the next 15 years. And then when I die, that $1 million policy I had is just reduced based on how much I've actually taken out. Is that right?
Yeah, absolutely.
As long as you don't reduce, this is the part I'm curious about. There's a barrier you have to make sure you can keep it at, like maybe whatever the premium would be that month. And I'm not sure if that increases as you age or if it's locked in forever. But if you start buying a boat and a new mansion, all of a sudden it's gone. Everything's gone.
Yeah, you could spend. Yeah, that's the other thing is you could spend it all. Now, one of the most popular company that we use, the reason I like them so much is because they have a pension option with it. And so if you get to 60, 65, 70, whatever, and you decide that you want to retire, you could turn on a pension from that money that's going to be guaranteed to pay out for the rest of your life.
And then when you die, your family still gets the rest?
Yep. And then your family gets whatever's left over.
How's that different than, say, you didn't have that little piece to it? Wouldn't you still have access to it and you can just set it up like, hey, just automatically withdraw $3,000 a month?
Yeah. Well, the difference is then there's no guarantee that it's going to be there. So, just to show you an example. So most people are used to investing, most people have their 401ks for retirement, right? How long does the average 401k last somebody into retirement?
I hope 20 years. Maybe I'm going to go maybe 15. I don't know.
7.
Oh, come on. That's not good.
Yep. Swear to God, 7. And the reason is because we have access to all of that money. So the day we retire, we turn 65, we could take it all out.
Somebody buys a new truck.
Exactly. We don't reduce our lifestyles at all. We start going on trips. We start going on all of these, excursions or buying all of these things. And so we just blow through our money so quickly, even though we're not bringing any more in. So people are retiring at 65. They're out of money at 72. They're going to live until their late 80s or early 90s, which leaves people, 10, 15, 20 years living on Social Security alone, which isn't nice for anybody.
Wow.
So to get back to the point of the life insurance. So yeah, you can take it all out anytime you want, but what you are risking is that you'll run out of retirement or you'll run out of money in your retirement. The other side is if with this pension option, you can choose that and they will pay you whatever that is for the rest of your life guaranteed. And it's still all going to be tax free. So even if the market tanks, and you don't earn another cent, they're still going to pay you that for the rest of your life.
And you get to pick how much that is.
Well, so based on how much you have saved, they'll give you a number and say, well, we'll pay you X amount. So,
So no lump sum payments. Like, right. I need 10 G's. They're like, you're not getting 10 G's. Yeah. You committed to 2,000 and that's all you're getting.
Yeah, well, that's the thing. So if you want the pension option, great, you can take it. And if not, you still have all that flexibility, take all the loans you want and all that. That's the give and take. You give up that guaranteed security to have that forever.
So that's the hard part is if you weren't disciplined when you were 40, not spend all your money, it's going to be pretty tough when you have a huge amount at the end.
Well, people get pretty conservative with their money once they get closer to retirement. I think 2008 really scared a lot of people. People who retired in 2007 and then a year later had half as much money sitting in their retirement accounts. People remember that. So
Yeah, I remember that.
People get pretty conservative once they get into their late 50s and 60s.
Well, and that's people that I talked to recently, they're retiring. That's something that they were planning for a long time is, I don't want to have a house note. I don't really want to reduce my lifestyle because I'm retired. But they're like, yes, then you need to make sure you don't have all these bills. Otherwise, it's going to be a problem. You're going to have to.
You're going to sell the big house, sell all the cars. You're going to, do all of that. Most people aren't.
Well, I didn't work 30 or 40 years to turn around and be like a college kid when I'm 70 again. What?
Yeah.
That wasn't the point. That was you're supposed to be living your life, and which is why some people say, hey, it's time to spend your money when you're younger and go vacation while your health is there. And
yeah. Well, and this is kind of a new problem. Think about your parents or our grandparents. They didn't have to worry about running out of money in retirement because they all had pensions. They worked forever at a company, they retired, and then they said, okay, well, we're going to pay you this amount for the rest of your life. Okay. Well, and then you made it work.
Yeah.
You knew what your budget was and you worked with it. Well, us with our 401ks, we don't know how to budget anymore, so we get pretty irresponsible with that money and we run out of it in 7 years.
It's important, like you said, have the 401k. A lot of us are self-employed. So, whatever that is, it's,
a SEP.
Let's just umbrella term it, your 401k.
Sure.
So you're going to get some money from that. You're going to have a little Medicare. Hopefully you got some Roths going on. And now a product like what you're talking about. So you have those multiple streams of income. So when you have a bad 401k year, you're not completely devastated.
Yeah. Well, we talk to people all the time too. Everybody loves the term diversification within your investments, but nobody thinks of diversification as far as your tax buckets. Do you have a pile of money that's going to be taxed when you retire? And do you have money that's not going to be taxed? And, how do you strategically kind of take that out once you get to retirement time? And do you even have any options? So it's pretty important to, put your money in more than one place for sure.
Okay. So let's talk a little bit logistics here. If you're 26, you're getting out of 26 to 30, you're starting your medical career. To me, that seems like a pretty good time to start buying some insurance. But if you're knocking on 40, and you're like, yeah, this sounds like a good idea. I think I still have a good 20 years left in me to fund this. What are some of the roadblocks that you might find? Like bad health, it costs $500 a month now. Like, what are we looking at?
Yeah, so it's not for everybody. You definitely have to be healthy enough to make it worth it.
Like when you start, or you have to stay healthy?
When you start, no, you can get real unhealthy after you start if you want.
Train for 30 days and get your blood work in order.
Yeah, exactly. But it is life insurance. And so that's one of the caveats is you got to be healthy enough to get it. And the healthier you are, the faster your money grows. And so like you said is, what's a good age for people to get started? My opinion is as early as humanly possible, and to get a permanent life insurance policy going right away if you can. And you don't have to have a ton of money to get it started. We work with people who do, $25 a month into something.
For a whole life?
Not for whole life, but
what you're talking about, the index?
The tax-free retirement.
Really?
And all of that. Yeah.
I thought that was the only prices you'd pay for term.
Well, the death benefit's going to be smaller, but
okay.
you can do as low as $25 a month into it. And so I think I'm a little bit different than most other financial people that you'll hear. But the reason I'm so passionate about people getting it early is because when I was in health insurance, we sold a little bit of life and we sold a lot of term. And I cannot tell you how many people would call me. They're in their 50s or 60s, and they'd be saying, hey, our term life insurance policy just, the term's over. The price just skyrocketed. We want to cancel it, but we need to get new life insurance. Okay, great. I can look at it. Well, $100,000 is $300 a month, right? Or something just astronomical, probably way more than that. And people just can't afford that. Or they might just be too sick to even get it at all. And if you think about it, if you're 21 or 22, that is the youngest and the healthiest that you're going to be. And if you can put some money away into a permanent life insurance policy, and you're going to do it at any point in your life, that's the time to do it, because it's going to save you the most money possible.
So at that age, like, we're parents now. We've got to look in the future.
Mm-hmm.
You almost have to, if you're smart enough at 20, can you imagine? Hey, parents, so I want to buy this policy.
Yeah.
That's $120 a month. I don't, I'm in school. I don't really have $120 a month, but this is something that I can do for the rest of my life. Maybe you can work something out with somebody to cover some of that premium until you get your feet wet and you're able to actually afford it long term.
Sure.
Like everybody talks about, I need to pay for my kids' education, but we don't really think about a gift like that. Like that's kind of a cool gift to give someone.
And we do that all the time. We call it a $1 million baby plan is kind of what we call it. But it's the same deal. It's a tax-free retirement plan on a kid. And we like them so much, number one, because you're getting them life insurance. You never know what's going to happen down the road. A lot of kids are developing some sort of condition or, cancer or whatever, even when they're kids now.
Obesity, 18 and they're 250 pounds.
Yeah, that too.
Good luck with life insurance.
Yeah. And so, I mean, if you can get them a permanent life insurance policy when they're, 1 or a couple months old. I got my son, he just turned 1 and he was 1 week old and he had 2 on him.
Good night.
So, yeah. And like I said, it's a great way to grow cash for college savings because number one, it all comes out tax free, right? So you can take loans from it. It doesn't count against you on your FAFSA, so you can get student loans, and it's not only used for education. So, I don't know if my son's going to be, responsible enough once he gets to college that I want to say, hey, I'm going to pay for all of your school. I might want to wait until he gets married and pay for a wedding with it, or put a down payment on a house or whatnot. But gives me a lot of flexibility and a lot of options to then help out my son in that case. And it doesn't necessarily have to go to a college.
Okay, so there's the question. You got this cash value. You do it when they're like less than a year. Now you got 18 to 20 years of growth, which is it's a good money. That's a lot of money built in 20 years.
Yeah.
And you say, you know what, kiddo, this is how I decided to pay for your college education just because of what you just said instead of it. But when you borrow, when you take out that cash value,
mm-hmm.
do you have to pay it back?
Now, you have the option to. You can. And I would suggest doing it if your goal is a retirement type plan. But you don't necessarily have to. And one of the amazing pieces to the tax-free retirement is the loan provision. So what that means is whenever you take a loan from your life insurance policy, they're going to charge you interest, right? Because it's a loan. Now, right. You're going to take let's just say 4% variable loan from your life insurance policy. And let's say that loan is $20,000 of your $100,000 you have sitting in this account. Okay, so the cool thing is they view these as 2 separate transactions. So let's assume the market does 8%. They're going to credit your entire $100,000 8%, and then they're going to charge you 4% on the amount, that $20,000 loan that you have. So even though you have $20,000 of it out in your bank account, paying for a car or doing whatever you did with it, it's still got a net return of an additional 4%.
On just that piece of what you borrowed.
Yeah, on the 20, to where the other 80 grew 8, that $20,000 loan that you have actually grew by 4.
Wow.
Yeah, so a lot of people don't realize, and that gets kind of complicated. I have to draw a lot of pictures when I'm explaining this to people because and I'm sure it's going to be hard to understand over a podcast, but that definitely is one of the most impressive pieces about taking loans from these policies.
So it makes sense. So let me just recap that. You have $100,000 in cash, 8% this year. Boom. They credit your account. Now you got $108,000 for the year 2020. Yes. And then you're like, well,
yep.
But I have a loan. I've got a $20,000 loan. So at 4%, and I've been paying that back every month. So I lost 4% on $20,000 because I had to reimburse myself. I had to pay back that loan.
No, actually, you gained 4%.
Oh, you only gained 4%.
Right, because if you figure they're charging you 4%, but the market grew 8%, so the difference between that 4% and the 8% is an additional 4%. So you actually grew that $20,000 by 4%, and
yeah,
that's with that 4% loan.
I got you. Your entire account still grew 8%, but 20,000 of it or whatever you borrowed, that 20,000 only grew because of 4 because you had to pay back 4 in. Okay,
correct.
Yeah. But in essence, your account still looks like it's supposed to. It's growing.
Yeah, still looks good. See how?
Yeah,
that's
I can see that pretty quick.
Yep. That's why I draw a lot of pictures.
Looking at this, okay, so you have your kid, you bought a policy for them. You're the custodian of it. So technically, like if they die, great. Not great, but you're getting the cash value.
Right.
But at the same time, can you still use it like kind of like your own and they never actually give it to them ever?
Yeah, absolutely. I'm the owner of the policy. So
they have no rights to your policy because you bought it.
Exactly. Yeah. Now they're the insured, and how it goes with life insurance is you can get life insurance on anybody that you have an interest in. So an insurable interest in. So I can do it for my son, my wife, my mother-in-law, somebody that you have an interest in keeping alive, basically.
But they don't actually get the money. You get the money if they were to pass away.
Exactly.
Now, if they paid it for themselves, that's different.
Yeah, it's my account. Yeah. Now, if they were the owner, they could do whatever they wanted. And it's always transferable. So let's say my son is very, very responsible, graduates from college. I could just give it to him. I could transfer ownership to him. He's now the owner, and he would have all of that. Yeah, all the life insurance, all the cash value, everything would be his.
That's quite the gift.
Yeah, absolutely.
That's quite the gift.
Yeah, we have a lot of grandparents that do it for their grandkids, parents who do it for their kids. So it's a pretty popular way to save for college for sure.
All right, so this is a funny question. It's kind of going into Justin's land now.
Okay.
So I'm 36. Okay, I'm 36. Right. You go get your blood work done. You're like, that's not quite what I was hoping for. And you find out your rate's like, oh, well, we got to ding you for it. You're not out of the park yet. You can't. We can still insure you, but you're gonna pay 20% more because you got this high piece here. So you're gonna. I'm sorry to say that, but you're gonna have to pay more. But you can still get it. And so you get that $500,000 policy. I don't know what that would cost. And you're like, dang. And then you start looking at your kid. My kid, they healthy. They can get that same $500,000 policy for pennies. And it's my policy.
Yep.
And the only difference would be the cash value is what you have. And if you died, you didn't help out your family. You got this cash value for retirement.
Yeah, exactly.
But you didn't actually help your family because you died in a car accident.
Hey, people do that actually. So there's another term on top of be your own banker and infinite banking. They're now calling it family banking.
Oh my gosh.
And that is exactly what you do is, you have a child and they're obviously very young and super healthy. Well, you can super fund a life insurance policy for them, put a ton of cash value into it and grow money that way. Now the rules of life insurance, your child can only have to what the parents have. So if I only have $1 million of insurance, well, that's the most my son's going to be able to get. So, but you can max fund it that way.
Oh, so if you don't even have life insurance, you can't just go and buy one for your kid.
Right. Exactly. Yeah. At least one parent, and usually the breadwinner has to have life insurance in order to get it on your child as well.
Okay.
Yeah. Now you're thinking.
That's interesting. I was like, that's a little wrench in the plan right there. It's like, all right, let's super fund the baby. Now, what does the word super funding mean?
So with life insurance, there's just a million ways that you can set these up to whether you want it to be funded to where the maximum amount of cash that you can grow inside of a life insurance policy due to, federal law and things like that. You can set it up that way. You can set it up to where I don't care about the cash value. I just really want permanent life insurance. That's all I want. So then that would be a different premium amount. And then there's somewhere in the middle called target. And so there's 100 different ways you can set it up. But the safest way to set up a life insurance policy to where you don't want it to lapse is by putting as much cash value into it as you can. And so that's what we call max funding a life insurance policy.
So does that mean like your premium's 100 and you put 200 in it, or just the way the premiums are set up in general?
It's a confusing little math equation that the government has for us, because what happens is if you go over that limit, it then becomes what we call a MEC, modified endowment contract. And so once it does that, it loses all of its tax-free ability. And so we don't like that.
Isn't that like the 80%? I've seen the graphs. So like one graph's at 2 inches high, and the next one's at like 1.75 of that line. So as long as it doesn't cross over that barrier based on like 80% or 90% of the value of the fund or something like that, then it's keep it below that. Or something.
It happens. Yeah, there's a whole math equation with it. Yeah, but what's nice is the companies that we work with, they kind of take it out of our clients' hands and they say, okay, if your client sends in, I don't know, a check for $20,000 or $30,000, but they'll only take 20,000, they'll send back the other 10 and say, hey, we don't want this to become a mech. Now, if you do, you can send it back to us, but we're just kind of protecting you. And, most people don't want to do that. So they take care of us.
That's real interesting. So it's based on what not your values, but what your goal is. Do you want cash value when you're older, or do you just want coverage when you die? Yep. And that'll definitely, one will have a much lower premium than the other is what I'm gathering.
Yeah. So just as kind of and it depends on the company and all of that, but easy rule of thumb is if you're max funding a life insurance policy, usually, or at least an indexed universal life policy, about 1/3 of it would go towards the insurance piece, and then about 2/3 of it would go into the cash value.
I'd be remiss without asking, you do this plan that you're talking about, the 1/3 to 2/3, man, all of a sudden you get into a financial crisis. And you're like, crap, man, I don't really have $500 to pay for this anymore. Like, I don't know what to do because I've been paying on it for 20 years. I still got another 12. But like right now, I'm about to go bankrupt. I don't have $500 for this life insurance policy. Are you out of luck? Can you use the cash value to pay for it? Can you just pay that 1/3 and just kind of sacrifice that cash value for a while? Like, what happens?
And that's another reason why I like the universal life policies over the whole life. So with whole life, if you miss a payment, they'll just cancel the whole life policy. And so now you're out. Yeah, now you're out of luck. But with the universal life policies, they're very, very flexible. And so as long as you have enough cash value in there to pay, like you said, that 1/3, you can take your contributions to it down to nothing if you want. And they'll just take that 1/3 out of the cash value that you already have. Or you can reduce it to kind of whatever you want, whatever's comfortable. I've had several clients use that. That's why I like this for business owners, is because as a business owner, sometimes you have great years, sometimes you have some pretty lean years. And so in the great years, hey, we want to put as much money into it as we can. And then in the lean years, if we can't afford to put anything into it, you don't have to. I've got a client who for about 2 or 3 years, they funded it 100%. Well, over the last year, it hasn't been a good year. They haven't put another cent into it and it's still rolling. So,
but you do risk 10 years down the road, you don't really have any more cash in there. And now you come knocking, hey man, you owe us $100 this month or your policy is going to lapse.
Yeah.
Like, it took 10 years.
Right. Well, if it takes 10 years, yeah, you might have other problems than funding that. But yeah, so you're right. That is a risk. If you have 10 straight bad years, then yeah, you could lapse your policy. But if you funded it well enough, and again, that's why I suggest max funding the policy, is because if you do that, that puts a significant amount into that policy every single month. So it really reduces that chance of that ever happening.
I know you can't do this, but I'm going to ask it anyway. A real snowball range in money we're talking. I don't know what's even a current setup. It's like 250, 500, 1 million. Is that sort of how it usually goes?
Well, actually, it kind of depends on how much. Again, depends on somebody's goals. So if it's cash value accumulation, then they might say, hey, my budget's $200 a month. Okay, well, then we would kind of go and see, all right, well, for that, you might get $150,000 of life insurance with it. So we figure out the amount of insurance on the back end because we want to maximize the cash growth.
So realistically, then when because it's growing, I'm thinking, man, 150,000 when you die, that's not really a life-changing amount of money. It'll support your family for a few years. But the whole point also is it's growing at 8% a year. So when you retire, that 150 might have a cash value of
you'll probably
400 or something.
If you're in your 20s and you start doing it, you're going to have way more than that initial death benefit was, for sure.
And okay, so what happens there? You got $500,000 in cash value. Your life insurance policy was only 150. They end up buying you more insurance to match that, or like when you pass, do you lose that 500 or you just get the 150?
So that's again, whole life insurance. What they'll do is they call it paid up additions. And so as you get dividends, you can choose to buy more of the life insurance, and then that way the life insurance amount increases. With the universal life, you can do an increasing death benefit so that every year some of your cash value does go to give you more and more life insurance. But again, it then becomes more and more expensive because you're paying for more and more of the life insurance. Or you can do a level death benefit to where the cost of the life insurance will stay the same. And, you get to, if you have $500,000 of cash value, well, then that would be the death benefit.
Okay.
So if you were to pass away, then you'd get the 500,000.
Okay, good. So I was kind of like,
Yeah.
man.
So you wouldn't only get the life insurance amount.
Okay. I'm always sketchy about some of these companies. Sometimes I'm always like, they're not going to lose. They're not going to lose. So sometimes they're like, well, good luck. You can't.
Yeah.
I'm glad you died because I didn't want to have to pay you back all that cash value. That's just us for me. Okay.
Yeah. Good to be looking out.
Any other risks that we might have missed?
As long as you have somebody an agent who sticks with you and does an annual review with you at least, either if it's every 6 months or every year, you really need that. The life insurance industry kind of has a bad name for people who sell a life insurance policy and then you never ever hear from them again.
Mm-hmm.
And that's just it's so common out there. So you really want to find somebody who's going to stick with you for the long term through this, because like you said, what if something happens like the market goes down 10 straight years? Well, what happens in that case? Well, you might want to ask a professional about it. Or what happens if I take out a big loan and I start getting letters, and what happens if this and that? You're going to want to ask somebody those questions, because the average person is not going to know how to read an entire life insurance policy and figure that out. Yeah, so if you're going to do something like this, you definitely want to trust, number one, the company that you're doing business with. You want to make sure they're a well-rated company. And then probably the most important piece is that the agent that you work with, you got to make sure that they're going to be in it with you for the long haul and not just, hey, buy this, and then you never hear from them again.
And also you got to look at, I think, what's the Roth max these years right now?
5,500 and then 6,500 if you're over 50.
So for a family of two people, that's 11,000.
Mm-hmm.
So like if you had only $11,000 to invest, or let's say 12,000 or something, the percentage of that should go to some kind of life insurance, and then the rest of that would go to your 401k, your Roth, or whatever. Like it's a piece of your financial budget. It's not like I do all of this, and if I have any left over, then I'll buy the life insurance. It should be part of your package of your total.
Absolutely. Well, and that's why, and again, the reason we use the company that we use is, everybody usually thinks of life insurance as, well, if I die, right, my beneficiaries get a big lump sum of money. Well, we work with companies that use living benefits, and most people have never heard of that. A lot of times when I say living benefits, they think of permanent life insurance policies that they could use their cash value for. But what the living benefits are, they're part of term or permanent, and it's built into the death benefit. So if you ever get sick, you can actually use your life insurance to help pay bills. So if you ever have a terminal illness, a critical illness like heart attack, stroke, cancer, or a chronic illness, which is very similar to a long-term care type situation, like you can't meet 2 of the 6 activities of daily living, feeding yourself, bathing yourself, things like that, then you can use your life insurance and they will pay you directly for that. And I wanted to bring that up because we have several doctors and groups of physicians who really love these living benefits because they see it every single day. They see how much the medical costs are for a long-term care type situation, or even heart attacks and strokes. And if your life insurance just already covered that, that takes a whole another product that you're probably already spending money on right off the table.
So instead of coming to come up with $30,000 a year for your ongoing nursing care because you can't feed yourself and take baths, your policy would kick in and pay for that for however long it takes.
Exactly.
That's great. I remember seeing that a long time ago. I asked the last guy. I think he wasn't really. I don't know. We were talking about so many things. It was hard to get that answer. So I'm glad you actually brought that up and made it super clear about that.
Well, and our company, we focus more on the money piece than just life insurance. But, the number one cause of bankruptcies nowadays, the number one cause of foreclosures and small business failures is all somebody getting sick. It's not that somebody passed away. It's just that they got sick. They might not be able to work for 6 months, 24 months. And where does anybody have a large chunk of money to, pay their bills if they can't work for a year? Well, the number one answer is their 401k.
Yeah. And that's when people take all those penalties.
Yeah, exactly. It doesn't take long to go through $100,000 if you're not working and have to take it out of your retirement accounts.
And you lose 30% up front.
Yeah, exactly.
There's a guy that I interviewed. He'll be, I think after you or one or two after you. He had two twins and they have a muscular dystrophy issue.
Mm-hmm.
That's going to cost $70,000 in like physical therapy every year.
Oh, wow.
For the next foreseeable future. And he's like, yeah, that wasn't part of the plan. And he didn't really say that, but he's just like, yeah, I had money, but now, like, my goodness, like, how am I supposed to afford that every year so that they can walk one day?
Yeah. When we talk about life insurance on kids, it's kind of a weird subject because nobody ever wants to think about anything ever happening to their kids,
My brother died.
Oh, really?
It was something my brother died when we were in high school. So it was one of those, my parents were glad they had a little policy because it was able to cover the funeral costs. And then it covered some things that me and my other brother, we were looking to do in high school and kind of in college. And so they're like, yeah, we have this extra sad cash, if you want to call it, but
sure,
it was able to fund some of the things that we needed to fund during those years.
I didn't know that.
Yeah.
Well, we being in this industry for a while now, I've heard plenty of stories, unfortunately, of, kids being only 1, 2, or 3 years old and developing something like, ALS or muscular dystrophy or something like that. And, the living benefits would cover that, if you needed all of that help and medical assistance and things like that. That's something that would be taken care of for you. And like I said, it's a weird subject to talk about just because nobody ever wants to think about it. But, it's a nice thing to plan for just in case.
And like I said, it's pretty cheap.
Oh, yeah.
To get a $25,000 policy on your kid. We're not talking you got to get $1 million policy for your kid or anything. But just to cover, like a funeral's 10 to 12 grand right there.
Yep.
And that's a lot of money just to come up with. And plus you're devastated at that point.
Yeah. Well, and that's a conversation I have with a lot of dads, as they say, oh, I'm the breadwinner. If something happens, they don't need any life insurance, on their wife or kids or anything. And I'm like, I can only imagine if something happened to my wife or my kid. I have a feeling I wouldn't be emotionally ready to just jump right back into work. That's pretty devastating thing. So.
Yeah. I was telling my wife about that too. I was like, she's like, yeah, you should get a policy. I was like, no, you need a policy too. Like, you like to go hiking and climb 20,000 foot mountains. I was like, you never know.
Yeah.
You just never know. And I was like, that'd be nice to, not just be worried about Justin having to, how am I supposed to take care of this kid?
Sure. Yeah.
By myself and work.
Yeah.
That's a lot of money on childcare that you wouldn't have had to spend potentially, if your wife didn't work.
Well, and wouldn't it be nice to not have to concentrate on that at all? Like if money was an afterthought and you could just concentrate on taking care of what you needed to, that'd be nice.
Absolutely.
Yeah.
I would like to end the interview with a little more lighthearted. And what about Trevor? You're married.
Yes.
You also have your own business. Yep. How are you able to take more vacations and also keep that love alive in your relationship?
Sure. Well, I mean,
you just went drive Ferraris. I don't know if that was a family vacation or it was on Facebook. This guy was first place, y'all. He was going fast.
Yeah, no, that was a pretty incredible experience. But that's kind of the nice thing about our industry is, we do get to go on a lot of vacations. We have a pretty generous CEO for our company who pays for us to go on a lot of trips, and our company is very family oriented. And so, when I succeed in our company, my wife is always named on any awards or anything else that we get, and any trips that we go on, she comes. So that's really nice. We get to travel a lot. And so, honestly, we haven't traveled a whole heck of a lot other than with work. We drive down to Texas, or we don't drive, we fly down to Texas and visit some friends down there and just kind of enjoy friends and things like that. But I think the thing that keeps me and my wife kind of together is just our sense of humor. She's kind of a goofball and I am too. And so, I don't know, we're just always laughing with each other and having a good time. So we try not to take ourselves too seriously and just enjoy life when we can.
Any hobbies? I think you're a golfer, right?
I love golf. Yeah. If I could do that every day, I'd be even happier.
Oh my goodness. I've sourced shirts like you're wearing right now. It's got like holes in it and everything. Some of these places, these are like custom fabrics. Like you can get it with just those big holes in it, but it's the whole shirt and then it doesn't look good.
Oh yeah.
I've been sourcing things in these China websites. I'm like, I was like, can I get some samples?
Yeah.
I'm always kind of thinking about something like, Because sometimes, as a chiropractor, different things, you want to give away some swag or like a podcast swag shirt or something like that. And I was like, I don't want to just give some dumb beefy tee that's trash.
Sure.
I want something that's going to be like, I'll wear it despite your logo because it's such an amazing
Absolutely. Yeah. What's funny is one of the shirts that I wear it a lot to the gym, is actually a Five Rings Financial shirt. And it's a tie-dye shirt, but it is so comfortable. And it says, keep Five Rings awesome, just all across the front. I mean, all you see is these big old letters.
My gosh.
I'm like, this shirt is great. And so I wear it all the time when I go to the gym. So I hear you.
Oh, man. Last fun question. We like to wrap it up here is any books or podcasts that you definitely would recommend for other people?
Oh, man.
Whether it's on the topic we're talking about or just in life.
Sure. Man, I read a lot of books, which I never thought I would ever say. Before I joined our company and I graduated college, I think I had told myself I'd never read another book. But that was pretty ignorant statement.
You just didn't find what you liked yet.
Yeah, and that's probably right. Well, as far as business goes, there's a book pretty much all about these indexed accounts and things like that by Tony Robbins. It's called Money Master the Game.
Oh, that's what he talks about?
Yeah, and he interviews the top, I think it's 50 or 100 money managers in the country, and kind of asks them, what can middle America do? And they talk about these indexed accounts. So it's a pretty cool book. It's a long read, and so I don't know if you want to read that or not, but it's a good book. But other than business wise, my favorite one, I really like those John Gordon books. Have you ever read anything by him?
No, what's the name one?
The Energy Bus is probably my favorite. And they're just these short little parables, really easy to read, but they really relate to, personal life, business, things like that. Just making sure the Energy Bus is all about making sure you have the right people on the bus, the right people on your team, the right people in your life to, help you move forward and be positive and things like that. And don't have energy vampires and people who bring you down in your life all the time. So I really like that book.
Bust, like a yellow bus.
Yeah.
Okay.
Yeah.
I thought I heard bust, like
No.
You went bankrupt bust. I was like, oh, okay. Energy bust. I was like, all right, that's interesting. I thought it was sci-fi for a second.
That would be a very different book.
Randomness. Sure. Game of Thrones, the finale was like the other day, and I don't watch Game of Thrones. I don't know if you watch it or not.
I sure do.
Weren't they books? Everybody's like, I can't believe. I thought they were a book.
Well, so they went off the book for like 1 or 2 seasons. And then after that, they started doing their own thing. So,
okay.
Yeah.
That's why everybody's shocked by the way it ended. I was like, guys, pick up a book. I could have told you how Lord of the Rings ends.
Yeah.
But I didn't want to read them. I wanted to watch it and see how it is. I wanted to be the suspense.
Yep. That's why.
Okay.
Yeah, because, since you don't watch it, but one of the biggest characters is Jon Snow. And I guess he died like 3 or 4 books ago. But he still made it to the final deal, so.
I watched a YouTube video and did like a 30 or 40 minute recap of the entire 7 seasons.
Oh, did you?
So, yeah, that's how I watched Game. I was like, oh, that's what this is all about. I was like, wow, this is really complicated.
Yeah, oh, man.
And there's only 1 season left. I'll just watch a 30-minute recap later and I'll know what happened.
You know what? Yeah.
Pop culture.
I didn't start watching until, I think, season 3. I had a buddy who was like, you haven't seen it? And I said, no. And he's like, well, you need to come over and at least just watch 1 episode. So I said, okay. So I watched the first episode and I was hooked. And it is such a good series just because, I don't know, I feel like I'm pretty good at guessing when somebody's, going to get killed off or what's going to happen in a movie. And just everything's so predictable nowadays. And with Game of Thrones, man, they keep you on your toes. The number one guy, the main character, he could get killed any second. So you have no idea.
Wow.
Yeah, it's
one of the recaps. They're like, "Oh, he got his head cut off." Yeah. Nobody saw that coming, and everybody's like, "What?" I was like, "Oh, that must have been a suspenseful part if you cared about this."
Yeah,
show.
Yeah,
but
pretty
anyway,
much, man. It's
a random way to end this episode. A show I don't care about, and a show that was like really popular.
Yeah. Well, hey, at least you can binge watch.
Now everybody knows what time of the year it was watched. Yeah, exactly. Yep. Everybody knows. I pre-record episodes, so you can put the two together when you actually show up in the live podcast here.
Awesome.
So, okay, last piece is, how do we get in touch with you?
Yeah, on Instagram, I'm a Safe Money Coach. And
Safe Money Coach.
Safe Money Coach, yep. And on Facebook, same, Safe Money Coach. You can email me at trevor@fiveringsfinancial.com.
Is that the number or the word?
Spelled out 5. 5 rings. Yep, financial.
Phone number's up to you, buddy.
Sure. Yeah, that's fine. 303-428-5434.
And good news is all this will be in the show notes page. We're going to have a dedicated note just for you.
Okay.
And as of the last probably 2 or 3 months now, transcripts. So the whole thing will be transcribed so we can hear all about what he had to say and you can read it if you just don't like his voice. Just kidding. But it is transcribed. So, man, I really appreciate the amount of time you gave and made it all, I think, clear. Pretty clear enough to where it's like, okay, I was confused. Now I know. And now I need to call somebody, whether it's you or you know how it is. You got to at least open it up for everybody to take care of that life insurance policy and do it in a way that can actually benefit you now and in retirement. So I really appreciate your time today.
Well, thanks for having me on. This was a lot of fun. Like I said, I've never done a podcast before. And yeah, this was a great time.
Another great interview has ended. As I always say, I hope you listened, critically think, and implement something so that your practice life, family life can improve this week. I want to hit you up with a few links today. If you'd like to know what the top episodes of 2018 and 2017 were, you can just go to .net/top1718 and you can get a PDF of all those episodes. It's like 22 of them. If you're interested on any of the programs that I've actually been interviewed on, just go to .net/asheardon. So play on as seen on, so as heard on. If you didn't know, the Needleless Acupuncture book sales page has been revamped, so it looks a lot better. Sometimes when you look at a web page and it doesn't look like it's put together well, you're like, I'm not sure about this thing. But it's been redone, looks better. And also, if you have an Android device and you're curious about it, you can actually now download the same 5 protocols, blueprints if you will, right there on your phone at the Needleless Acupuncture app. And for less than $4, you can get the whole book on your phone from the Android Google Play store. So if you're interested, check that out. The electric acupuncture pen is still available at a great rate. You can get it on its own or as a package. So you can get the book, the e-pen, as well as the auricular points. Now, some of the things that I'm recommending, Blueberry Hosting, that's who I use. I really like them a lot. I'm not going to lie to you. Fiverr is where I get a lot of my music done, my logos. I don't know if you noticed on Facebook, I believe my picture is now a face with a bunch of words. I just saw that real quick. It was cheap. Yeah, why not? I'll try that for a little while. It's fun. Turtle pillow. It's a travel pillow. It actually has like an H-beam in it, so you can rest your neck and your chin on that, so you don't get like the chicken bob where you're sleeping and you wake up really fast, and those U-shaped ones. I just don't think they work very well. So for me, it's worked really well. I've traveled 10 different countries with it. Across the pond, as they say. Really highly recommend that. If you're into instrument-assisted soft tissue manipulation, 2 options. You got Hawk Grip, so .net/Hawk Grips, and also .net/Edge. And you can get tools there as well. But they also have way more than just tools. They've got how to use Google Apps as your EMR. Blood flow restriction cuffs. There's a lot of research on that device. And you can check that episode from the past. And you can get an automatic 10% discount on all the products from the Edge mobility equipment. One of the devices I use to send out snippets of the podcast via picture and quotes from the text that I write from the show notes is Missing Letter. They just took out the last E in letter.com. Pretty much, you can do a blast in 2 months, like 5 emails over 2 months. I like to do 9 emails over 12 months. So that person who was interviewed last month doesn't just get lost, right? So every day I have a new episode that I highlight and it's all automated. It's really cool. Definitely check it out. If you need to record your screen, I like Screencast-O-Matic. Also, JLab audio speakers. I've said it before. I love them. It's a great company. And now I get to actually be an affiliate for them. So if you end up buying any of their products, just like any, I get a little piece. Probably have like 3 or 4 different products. I mean, the battery lives are longer. Sounds quality is amazing. And for the price, you can't love it a bunch. And of course, in the show notes, anytime you see a book link, you buy it, it comes to me. And .net/t-shirts will help us out. And lastly, again, something I don't talk about too much, but if you need coaching, whether it's via the Today's Choices, Tomorrow's Health, you need some help with taking those small steps and accountability so that you can actually lose the weight or start exercising more or get your budget in order, just let me know. I can help with that. Also, if you just need some minor marketing coaching or things like that, I can help you out with that as well. Just go to .net/support. And of course, on there, you can also host a cup of coffee or even more than that. There's different options available. So thanks for tuning in, and we'll see you next week or on the mini-sode. We just went #behind the curtain. I hope you will listen and integrate what some of these guests have said. By all means, please share across your social media, write a review, and if you go to the show notes page, you can find all the references for today's guest. You've been listening to Dr. Justin Trosclair, giving you a doctor's perspective.